You're listening to Investify, preaching financial independence and assisting investors to achieve a more flexible and free lifestyle through smart financial planning and real estate investing. If leaving the corporate world and jumping into this thriving industry is what you desire, tune in and listen to stories of like-minded individuals who made the leap to financial independence. Equip yourself with the right tips and tricks to start your real estate journey, making active or passive ventures that are highly profitable and rewarding. Here are your hosts, Craig Kurlop and Ziana McIntyre.
What's going on, everybody? You are listening to Investify. My name is Craig Kurlop, and Ziana tried her best to get on to this episode, and she was even on it for a little bit, but then her internet copped out. Man, it seems like the God or universe or whatever you believe in is just not wanting Ziana to do anything while she's on her vacation. So I hope she is enjoying Sicily. We're going to hear all about it when she gets back. But today's guest is Dylan Koch. Dylan is a great friend of mine. He's into real estate. He started off kind of, just house hacking like a lot of us have, and then has kind of grown into the side hustle of wholesaling. And now he's raising other people's money and all that kind of stuff. And so, again, I think this is kind of a great place to be and position yourself as like, okay, this is like the next step, right? Like this is what house hacking and real estate investing allows me to get to. It allows me to start. He's still in this very, very early stages of this kind of phase 2 of financial independence. So it's really exciting to hear him talk. But without further ado, let's bring Dylan Koch onto the show.
Hey guys, if you're thinking about becoming a real estate agent like us, you might want to go to Kaplan. That's where I got my license, and I found that they made all this really dull information actually kind of interesting and very memorable. So if you're looking at getting your license, see if they have your state. They cover a lot of states, but not all of them. And if you want to get a little discount, use our code INVEST2. So the word invest and the number 2. Thanks, guys.
Welcome to the show, dude. How you doing today, man?
I'm doing well, Craig. Thanks for having me.
Thanks so much for coming on, man. We've gotten pretty close here over the last 6 months or so, and I'm just loving to hear your journey, and I want to share this with everybody. So why don't we rewind it back a little bit and tell us, when did you first hear about financial independence?
Yeah, no, great question. And then I haven't reflected on this stuff in a while, so it'd be good. I'd say it probably would have been around 2016. And that would have been when I was in pharmacy school, right? And the thought process was, hey, money's important. You're going to make decent amount of money coming out of college. You should know what to do with it. And so I just started going down the personal finance rabbit hole. First person I read was Dave Ramsey's Total Money Makeover. And as you go down that rabbit hole, Mr. Money Mustache, and then eventually Robert Kiyosaki, which, those two have kind of polar opposite views. And then just really the FIRE movement, Bigger Pockets was part of it. So I'd say 2016 was my first introduction, but I didn't capitalize that until, a couple of years later. Awesome.
And so what did you read? Honestly, full disclosure, I've never actually read the Total Money Makeover. I tried and I was like, I think I'm beyond this at this point. So I think I just was introduced to it too late. Yeah. But what did you gather from that book that you took with you?
So at the beginning, it was the only thing I knew. So I followed it basically to a T. And the biggest thing was, debt is bad. That's like the biggest takeaway from that book. And it didn't really discriminate between whether that's high interest, like personal debt, or if that's debt used to buy a property or a house. It just basically said all debt is bad. And that was my thought process for the first couple months while I'm starting this financial literacy that I'm taking myself down.
Couple of months. So it didn't take you too long to realize that, okay, maybe some debt is good. What book did that shift happen for you?
Definitely. I know it's a cliche answer, but Rich Dad, Poor Dad.
Okay.
So I'm curious about what would have got you into real estate? Because with Dave Ramsey, it seems like neither of those are that into real estate. So, I know Robert Kiyosaki is just totally into real estate, but where did you kind of have that transition of going, oh, this is good debt?
Yeah, so definitely after reading Rich Dad Poor Dad, and that would have been probably the year later, about 2017 timeframe.
Okay, cool. And so, we talked about this good debt and bad debt. What is good debt? What is bad debt? Like, what was your definitions then?
Yeah, so I guess bad debt would be anything that use debt that doesn't produce income, in my opinion. So high interest credit cards is probably the best example of bad debt. And then good debt, I would consider basically you can go out and buy, a single family home or a duplex, and that can either reduce your living expenses or even put some extra couple $100 in your pocket every month after you're paying for those expenses and that mortgage interest. And if you can fix that in for 30 years, so yeah, you pay off your debt for 30 years and your fixed costs. So the basic definition to me was personal debt is bad debt and income producing debt is good debt.
I love that. Yeah. So don't put a vacation on a credit card. What about a car? Would you consider a car bad debt?
Yeah, I consider a car liability because it goes down in value once you drive it off the lot and it costs you money. It doesn't really make you money. I know you can do like the Turo thing now where you rent it out, but traditionally I would view that as bad debt.
Great. I love that, man. Yeah, I love that concept too. Whereas, the only time you're taking out debt is to buy like an asset that's going to provide you income. I used to be like very big proponent of, pay your cars in cash, blah, 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 because cars do devalue. However, like as you get a little bit more sophisticated, I think you can start to take on a little bit more of this riskier debt, which maybe a car loan, I think would be like the next step up of that, because car loans are relatively cheap. Yeah, it's not giving you income, but right, instead of paying $20,000 for a car, you can just put $2,000 down, have a monthly payment, and you got $18,000 to go ahead and invest. Right. So as long as you're investing that additional money and not just blowing it on whatever, then it may make sense. But again, you just have to, and it's all about your risk tolerance as well. All right, man. So you went from that journey of debt is bad to some debt is good to, okay, what happens next after you read Rich Dad Poor Dad? And this is 2017. You read Rich Dad Poor Dad?
Correct. And so I graduated pharmacy school. My first job was what they consider a floater pharmacist. So I'm driving all around Cincinnati and Dayton and just listening to as many podcasts and audiobooks that I can. Bigger Pockets being one of them, Rich Dad Poor Dad, like the series, like all the purple books. And so I basically started on episode 1 of Bigger Pockets. And it was like, okay, let's see what this stuff is about. And through that education, I was like, okay, let's see if there's a local meetup. And Joe Fairless at the time ran a local meetup here in Cincinnati. And I showed up that first meeting, again, probably 2017. And I couldn't tell you the difference between Joe Fairless or Brandon Turner. I couldn't tell you anything about real estate. But I met an agent there who was like an investor-friendly agent. And so we had coffee, and I was like, this is what I'm looking to do. I'm looking to do this house hack thing where I can lower my expenses. And basically, long story short, June of 2018, I bought my first house hack here in Cincinnati.
Okay, awesome. Yeah, no, I think that's a great, obviously I think a lot of people fall down that rabbit hole. I had a similar trajectory. And so June 2018, that is the for real deal. That is the first deal you did as an investor, an intentional deal as an investor. And so we're going to dig deep into this deal, Dylan. And so why don't you tell us kind of what that deal looked like, what the price was, all that good stuff, and we'll dig in a little deeper.
Yeah, absolutely. So it was a duplex here in Cincinnati in a good part of town. And it was the purchase price on it was listed at $270,000. 2017 was still kind of a seller's market, and I was an FHA buyer at the time because that's what I thought you were supposed to do as a first-time home buyer. And so ended up being down. I ended up purchasing the house for $272,000, and I think I ended up paying the closing costs as well. And so I came to the closing table with I think it was like $11,000 out of my own pocket to purchase this duplex. The interest rate was around 4.5%. And so my principal and interest, I actually have this written down, was $1,177.78 per month. And then taxes, if you do that, is like $455 a month, and insurance was like $100 a month. in total, my principal, interest, taxes, and insurance was basically $1,750 per month.
So you bought this thing for, you said 215,000?
272,000.
272,000. Okay, sorry, 272,000. You put about $10,000 or $11,000 down, and your monthly payment total is $1,750. Did you say this was a single family home, a duplex?
It was a duplex.
A duplex. Okay, and so how did you address that situation? Did you live in one side, rent the other, or what was your strategy there?
Yep. Nope. Lived in one side, rented out the other. One thing that I have now I know now that I wouldn't do again was the utilities were not separate in this duplex. So all the utilities were in my name. And so you add that cost to the living expenses. In total, that was like $350 a month. So my in total, like what it cost me was like basically $2,100 a month total. But I was renting out the other side for $1,500. So my living expenses were about $600 all in for everything. And living in a good area of Cincinnati where someone else is also paying down the debt and obviously the tax benefits and appreciation that's happened since then.
Wow. Wait, so you're not house hacking right though, bro. You're not living for free, right?
Yeah, I know. And when I first learned that concept, I'm like, well, and I was running all the numbers, especially where I live. And unless you wanted to live in, a not so great part of town, like you just couldn't make those numbers work.
For sure.
And so but I was still lowering my living expenses. I was 24 years old, making decent, good money for a 24-year-old, and I didn't have a car payment. So I was able to stack away cash during this first house hack.
Yeah. And that's kind of the point. That's kind of the point I was making, right? I was kind of being a little facetious there. Like you don't need to, be cash flowing while you're living there. On a house hack, because you're saving money in rent, and that's effectively cash flowing, right? Like the less money you spend in rent, the more you can save, and then the quicker you can buy the next property. And so, yeah, not all house hacks work out like that. And so, renting out the other side for $2,100 in payment, getting rent for $1,500, $600 of deficit that you had to pay towards it. And what would your side rent for?
$1,500 probably as well.
Okay, perfect. So that's perfect cash flow. All right. So you bought this house for $270,000, right? You got $3,000 in income coming in, including the rent you're paying yourself. Your mortgage payment's $2,100, and that includes your utilities and all that good stuff. And so you're basically cash flowing $900 a month on this duplex, right? Like that's a very big leap towards what I suspect is your goal of financial independence. Now, what we didn't talk about yet is, did you have to put any other money into the house? Like, did you have to fix it up or anything, or did anything else go wrong?
So it was pretty turnkey when I bought it. However, within the first 6 months of living there, I had to probably pour another $7,500 into it. I ended up having to put a new roof in, and I ended up also replacing 6 windows just because they were the old original wood windows. So I didn't necessarily have to do that, but I just did. Help lower the utility bill. And then one other thing that happened was this house it was old. It was 1911, I think is the build. And so it had the box gutters on the top, which are like this wood gutters that it was popular back when those homes were built. And to replace them is very expensive, or to fix them is very expensive. I didn't know that at the time. So I actually just ended up doing, I had them sealed, which cost me a few $100s versus the $20,000 it was going to be to get them actually replaced.
Wow. Okay. So what was your total amount into the property or the rehab?
So with that, so it'd be another $7,500 out of my own pocket.
Okay. So all in, right? Let's just be conservative here and say, you put 20 grand of your own money into this deal between the down payment, the closing cost and the rehab. You've got, so one, right, you're basically buying this house in perfect condition after you've done it for basically 10% down. And then today, what is that property worth?
So I did end up actually selling that house a couple years later, but I sold it for $335,000 about 3 years later.
Okay, so 3 years, $335,000. So you're looking at about a $50,000 gain over the course of 3 years, right? And so mind you, you're in Cincinnati, which isn't like the highest appreciating of markets, but it's still appreciated. And so, you're looking at an extra $20,000 a year in appreciation. You got your loan benefits, you got your tax pay on, all that stuff. And so you're looking at well over 100% return on investment just on the $20,000 invested. And that doesn't even include, the $1,000 a month or so you got in cash flow. So why did you sell the house?
You kind of hit on this earlier when you were talking about opportunity cost. where I was, not to sidetrack too quickly, but I had another partner that was a pharmacist. We were working together. So I mentioned we bought this primary residence, or I bought this primary residence in June of 2018. Well, this partner and I bought another duplex in August of that same year. Then we bought another duplex in January of the following year. And then we started running low on cash. So we're like, hey, well, I can take this money from this place and have opportunity cost to put this money somewhere else. And it was to basically grow the real estate portfolio quicker.
Gotcha. Perfect. Yeah. And that's a perfect reason to do it. I think as you level up and grow it, people tend to sell their, the properties that aren't working as well to then go ahead and buy other ones that are more aligned with their goals. And so, all right, man, what happens after this first property? So, this is what, 2017, you bought your first one?
2018, June of 2018.
Okay. Yeah. So June 2018, you bought your first one. And so what happens next?
So, yeah, as I just alluded to, I had a very close friend of mine in pharmacy school. We had very similar ambitions and goals, and we're like, this, let's form a partnership. Let's go down this rabbit hole together. And so we used that same agent, and we just were running the numbers on the Bigger Pockets calculators. And we're like, hey, if it hits, $200 per door in cash flow and this cash on cash return, let's buy it. Let's just do it. And so we ended up buying another duplex together in August of 2018. So 2 months after that. And then we bought another duplex together in January of 2019. So 3 months after that. And that was the start of that.
I'm curious as to how you found your partner. One, how'd you find him? And two, how'd you structure things?
So yeah, my friend and I, we knew each other from pharmacy school. There was a level of trust already built into our friendship. We had done the battle-tested degree together, which is, a lot of sacrifice and time together. But as we're going down this financial independence rabbit hole, we're talking about our ambitions and using our pharmacist income and low expenses to basically build a real estate portfolio together and build our passive income. And so we just had metrics that we wanted to follow. We were like, if it produces $200 per door in net cash flow, and then also it has this, specific cash on cash return, which I believe at the time was 12%, then we're like, we'll buy it. And so that's kind of the path that we went out on. We used the Bigger Pockets calculators online, and we used that same agent that I met to buy my primary residence. And so he kind of helped us since these were our first couple of deals. And yeah, so we bought one August of 2018, and then again in January of 2019. Okay.
Awesome, man. I love that. And so how did you structure that partnership? Did you, was it 50-50? Did someone have come to the table with something more or?
Nope. It was 100% 50-50 split down the middle. And we did instead of a JV, we did do made a new entity and everything.
Okay. So made a new entity, and then, and so you went through the correct way of you got maybe not a lawyer, but did you get a lawyer involved? Did you make sure that
we did.
We did. You did.
So, yeah. Everything on the forums was like, hey, set this up right from the beginning because you never know what's going to happen. And the agent we were working with knew a CPA, knew an attorney. So we sat down and they did the legal, operating agreements, beneficiaries, what happens if someone dies, gets married, has kids, all the things that go into the planning of something like that.
Perfect. Yeah. I can't, if you're going into partnerships, man, having a poor operating agreement, it will just destroy you if anything happens or if things start to go awry, especially if it's a long-term partnership where things change, circumstances change. And so I love that.
And Craig, I don't know if you want to talk about that, but this partnership has since, ended, we're so great friends having that in place there's no tension when it happened because we don't know, we already have pre-decided what's going to happen with all those assets.
Yeah. Yeah. Okay. Yeah. Curious if it ended, I would love to hear that story as to what caused it to end, why it ended and how it ended.
Yeah, no. So I think that basically, as you alluded to earlier, life happens. I've since got married, and then our financial goals and how to get there started to differ. Our opinions started to differ. One wants to do more commercial, and myself, I wanted to start basically this real estate investment business. And so that, I know we're jumping forward a lot, but in September of 2021 is when that happened, and I left full-time pharmacy to do this. But up until that point, we had 13 units between single-family homes, small, duplexes, and when that ended, it was basically hey, we're going to sell everything off, split the proceeds 50-50. Yeah, we're going to have a tax bill, but Ton is still one of my best friends. He was in my wedding. We're great. It's just I guess, if I gave any advice to someone out there looking to do partnerships, is have all the documents in place first. But additionally, I'd say our downfall was not downfall, but we were too much alike, where his strengths are my strengths, my weaknesses are his weaknesses. And so there wasn't a ebb and flow to anything. It's just, we both enjoyed the underwriting, the looking for deals. None of us liked the property management or the other aspects of owning real estate. And so, of course, that didn't help the longer that went down the road.
Yeah, lots of great advice there. I think you definitely need kind of like a yin or yang, right? When you're finding a partner, right? Like you have to be good at one thing. And so you may not get along with that person that much, which is funny because oftentimes you get along with somebody that is kind of similar as you, right? Because you're relatable. And so, maybe find someone that can challenge your views, that you have frequent discussions with. And that's how a business really fulfills and grows. And that's kind of like the puzzle piece that puts it together. So I love that, man. And so you had 3 properties in this partnership then?
Hey everyone, big news. Investify has now partnered with RentRedi. And yes, we've partnered with RentRedi because that is the software system that both me and Ziana use to do property management for our rental properties. It makes things super easy. We can send applications, get background checks and credit checks. Tenants, when they come in, can pay rent automatically through there. They can submit maintenance requests, do everything you need to do for property management all in one place. That's why RentRedi is the thing that we've done. I've been using them for years now. And that's why we reached out to them for a relationship on the show. And so again, super excited to have them on board. If you go to rentredi.com and use the code Investify, you'll get 50% off your first 6 months. That's right. 50% off your first 6 months. If you go to rentredi.com, sign up and use the coupon code INVEST2FI. And can't wait to see you there. Let us know, hit us up on Instagram, hit us up on wherever, and let us know what you think of RentRedi. Because again, I think it's an amazing software. I use it all the time. You can access it from your phone. Amazing stuff. So thanks so much. And let's get back to the episode.
So I ended up gotten to 8. I think it was 8 with 13 doors.
Okay. 8 properties with 13 doors. Now, curious as to how you scaled that quickly. Was it how did you come up with the money for all that?
So a lot of it was, we were living so cheap and we were working a ton of overtime as pharmacists. So we were able to stack away, combine probably $7,000 to $8,000 a month just to store up some of those down payments. But the more we kept learning about real estate and, the fancy term of other people's money and the Burr method, we're like, hey man, this makes sense. Let's increase our velocity of money. If we can turn around, let's do it. And so we decided to pursue that method as well.
Dissolved your partnership. What happened to those properties? Did you buy him out or how did that work?
We basically sold them all through a real estate agent that helped us. And we split the proceeds 50-50.
Okay. So what happens if you didn't want to sell them? Did you feel like you had to kind of give in because he wanted to leave?
No, I think it was mutually agreed upon. And I guess at the time, it was simple. And at the time, my thought process was, some of these are in Northern Kentucky. I don't really want to be down there anymore. I'm focusing up more north. So, and it was opportunity cost again. I can take some of this cash. Yes, I'm going to have to pay the depreciation recapture and some of this stuff, but I can take this cash and use it for building my own business, which was starting to do the off-market stuff, which takes a little bit of money up front to get that business going.
Awesome. All right, man. And so I guess so that feels like a pretty big transition. Where are we now in terms of years? When did your partnership dissolve?
That would have been September of 2021.
Okay, September 2021. Okay, so we're kind of to recent times. Now, were you buying properties yourself throughout this time, or was everything you were buying just into the partnership?
Everything that we were buying were into the partnership.
Okay, perfect. Then you mentioned other people's money, which is a fantastic way to scale in real estate. And that's really probably the only way to scale at any sort of, big time thing. And so how did you start raising other people's money? How do you have that conversation with somebody?
Great question. And I would say the biggest thing is just networking. We are going to every local meetup, the RIAs, reaching out to people who would post on Facebook groups or the Bigger Pockets forums and just meeting people in the space. And just through those mutual connections, you start to talking with other investors. And I think if you can prove that you have some level of competence, or you can prove like, hey, this is what we did with, our first 3 properties or first 4 properties, they can get behind you. And they were just looking for a place to they're sitting on a lot of cash. They want to get a return on that. And we were able to provide that for them.
So when you maybe like a third partner in each deal, I think a lot of people get bogged down with the idea of like, oh my gosh, I have to have a fund and then I have to go through the regulations and all the things that complicate that.
Yeah. So, when you do your real estate education, you're going down and you're learning about syndications and all this kind of stuff. A lot of people who get down this space, they're like, I want to go big, I want to, go as big as I can. And you learn about syndications and whatnot. But at the end of the day, maybe it's just my personality where I like to have a lot of control over the deal, and just being able to be local in my market and, in some cases get infinite returns on some of these first deals was more appealing to me than going out and doing the legwork, paying the attorney like 30 to 50 grand for the documents you need to file with the SEC. And I just didn't feel like we were at the stage where you're competent enough to do that yet. We found something that worked, and we were very just focused on working at what we knew worked already. It seems like
people put this like big thing on raising other people's money, right? But I don't think it needs to be that way, right? Literally, it could be like, hey, Dylan, I'm investing in this deal. I need $50K. You got it? And you're like, yeah. And I'm like, okay, cool. I'll put you as part of the operating agreement for this entity, right? And that's like it. It doesn't have to cost a lot of money. It doesn't have to cost a lot of thing. There is a little bit of added pressure that, hey, I've got your money now, and I want to make sure that I get you your return. But that's really it. And so I want to say, like, if you are looking to scale, start networking and start getting into rooms with some people that are going to have some money, and start making connections with them, because that will be the ones that will be giving you the cash.
Yeah. I mean, write down like the 10 wealthiest people you think and just start reach out to them and say, hey, this is what I'm doing. Are you interested? And you'll be amazed at where those conversations will go. Maybe they're not interested, but they know someone who is.
100%. Love that, man. And so, all right, man. So I love how you kind of scaled that business. You scaled your partnership. And so what happened in September 2021 when you and your partner kind of ended? Are you still buying real estate in the same way? Are you shifting gears a bit? What happened?
Yeah, great question. So he's off doing commercial stuff and a little bit bigger deals. And I more wanted to focus off getting my own deals off market and building a cash flowing business where I can use the cash flow to buy real estate for myself. And so I did end up joining another mastermind. Ryan Dawsey, who I think has been on Bigger Pockets a couple of times, has what he calls CCF, or Create Cash Flow. And the impetus was, how do you run a real estate business that produces off-market deal flow, and how can you scale? It's the whole 9 yards. And so since that time, I left pharmacy full time, and I still work in the pharmacy basically 1 to 2 days a week. I keep my licenses as kind of like a backup plan in case I can't, this doesn't work out. But since that time, we've done about 7 deals with one other in escrow. As far as wholesale deals, we've done 1 flip and currently have 7 units, 1 more in escrow, which would make 9, and another offer out there that'll make 10. And so that's been in less than a year, hopefully up to 10 units by the time that first year has been since the transition.
And that's 10 units that you transacted, or 10 units that you actually own yourself?
10 units that I own myself. And then there's been 7 other, or 8 other transactions that I no longer hold.
Okay. And how much does a typical wholesale deal go for?
So it depends on your market. So literally my lowest one has been $3,000 and my highest one has been $15,000 so far. But I've also talked to people that, they can go a lot higher than that too.
Right. And I know you're in kind of a cheaper market in Ohio. And
Correct.
So, yeah, if anyone's out there looking for kind of a side hustle and you like to find deals and work with sellers and all that, like wholesaling is a great route to go. And I know Ryan Dawsey's got an amazing mastermind group. And so in any sort of thing, when you're starting a new business or starting a new venture, look to see if there are any masterminds of or anybody that you can get around that can help you in that endeavor, because that's huge, right? I suspect you attribute a lot of your success this quickly to CCF, or are you just a maniac?
Well, I will say I work very hard, but no, definitely being part of the group and being around other people that it's just like could you sit down and listen to all the podcasts, go through YouTube and figure it out? Yeah, probably anybody can, but it might take you twice as long to figure that out. So get in front of people that can shorten that learning curve. And so that way you can scale quickly. Yeah, it might cost you some money, but back to our opportunity costs and time on your, cost on your time. What does that mean? It's hard to quantify something like that.
Yeah, man. I totally agree with that, right? Like shortening the curve is something that I used to be super hesitant about. Like I'd rather just do it all myself, right? I'd rather save the 10 grand. But when you think about like, if you could just do 2 deals, like it would probably take me a year to educate myself and get to the point of where you are by just like initiating into this program. And so how many deals could you do in that 1 year? Definitely more than $10,000 worth. It's just hard. That initial spend is hard to digest. But I want to say, like, Grant Cardone always says, if you have $1,000, he recommends spending that $1,000, invest it into yourself. And so by investing in the masterminds and getting those connections and having those friends and being in that tribe, that is what will definitely propel you to the next level. So I love that, man. All right, Dylan. So this has been awesome, right? So we talked all about how, your journey from Dave Ramsey all the way into Rich Dad, Poor Dad. So debt is bad. Now debt is good. Then you started, buying house hacks kind of by yourself. And you were like, okay, like I could do more if I have a partner. And so you bring in your partner. You guys are both pharmacists making good money. You start buying stuff together. The partnership didn't quite work out. You went your different directions and you started raising other people's money. And so I just love that scalability as to going from, hey, I've got 1 or 2 house hacks, and now, hey, like the world is my oyster and I have hopefully unlimited funds that I could potentially buy deals with. And so I think, I guess I want to hear next, like where do you expect to go here in the next 1 to 2 years?
Yeah, great question. And so a lot of this is, Robert Kiyosaki talks about the cash flow quadrant, and I have definitely been the S, which is like the self-employed part. So I want to make that more towards the B part, the business owner part. So I'm going to another event here later in July that really focuses in on, okay, how do you scale? What do you outsource first? Is it the bookkeeping? Is it your marketing, pulling your list, part of this real estate business? And so that way it's the cliche of don't work on your business. And so that's next for me is how can I not only increase revenue and increase profit, but also decreasing the amount of time that I have to be involved.
Love that. Yep. That's how you scale, right? Like the only way to scale is to get your time back so you can work on growing the business versus just operating the business. So, and what's that conference called?
So this will be, it's called Results Driven, and it's driven by a woman in Columbus, Ohio, and they do a massive amount of volume here in the state of Ohio. Okay,
awesome. That'll be a great event. Awesome, man. Well, it sounds like, you're headed in the right direction towards scaling up your wholesaling company, scaling up your investments. Is there any other final words you want to gift to our audience before we head into the final 4?
No, I think we can just head into the final 4. But I will say, if after the podcast, if anyone wants to reach out, I can talk about this stuff all day, every day, or give advice. So that'd be great.
Awesome, and we'll ask you for your information at the end. So make sure you're listening through to the end. All right, now it is time for the final 4. All right, Dylan. First question: what book are you reading right now?
Craig, I didn't know your voice could get that low.
I didn't know it could either.
Yeah, right now. It's the Gap and the Gain by Dan Sullivan.
Great book. That's a classic. I love it. Second question: what is the best piece of advice you've ever received?
Ooh, good one. I would say feel the fear and do it anyway.
Feel the fear and do it anyway. I love that. Kind of like lean in, right? Like lean into your discomfort. Yeah.
You're not going to get, you'll get 80% of the information and then pull the trigger. You're not going to have 100% of the info. You got to just go for it.
Love that. All right, man. What is your why?
Yeah, like most people probably on the show is financial independence and more so time freedom. So like do what you want with who you want, when you want. And then there's also a component of like the legacy aspect for me where, I would like to set up, our family for generations to come and eventually, give back to the causes that are near and dear to myself and to my wife.
Love that. Last question. Why do round pizzas come in square boxes?
I think I've heard this before, but I have no idea. The geometry is my answer.
Geometry? Yeah. I was trying to think about this. I was just heard this question for the first time today. And I was like, why is that the case? I think it's so you can like cut it, but no, it's already comes cut. That actually doesn't make any sense. I don't know.
Yeah.
Who knows?
Well,
Who knows?
all right. Well,
the world.
Tell us in the comments.
Yeah, tell us in the comments. All right, Dylan. So how can people find out more about you, reach out to you, all those good things?
Instagram's like 11D Koch, I think. And I have an Instagram, a Twitter, a Facebook. So I'm sure all that'll be in the show notes. Or if you want, you can even probably put my email in there. I don't care. I'll probably respond to that too. So
perfect. All right, Dylan. We'll definitely hit up Dylan on his IG or wherever else you can find him. And thanks so much for coming on the show, dude. This has been an inspiring episode, and we'll see you next time.
Yeah, thanks for having me, Craig.
All right, later.
Yep, bye.
And that was Dylan Koch. Man, I just love Dylan so much. I love how just genuine he is, and I love how much like kind of passion he kind of brings into the conversation. I love how he went, like his journey is like so crystal clear. I think a lot of us have maybe followed the same road of, okay, you start with Dave Ramsey, and that's kind of like level like 0 of financial literacy. And then you're like, well, okay, there's some ways to be more efficient. You read Rich Dad, Poor Dad, you understand that, okay, some debt is good, mortgages, and maybe some other business debt might be okay as long as it's helping you make more income. And then you start using what you learned to buy real estate and to buy other assets that provide you financial independence. And then you get to this next phase of kind of lean financial independence where you've got a handful of rental properties making you probably between like $3,000 and $7,000 a month. And now you've kind of got your bases covered for what is financial independence. And now you can go ahead and start to really scale your business. And I love that Dylan is kind of right at that point of scaling. And I bet if we called him back in a year or two, he's going to absolutely be crushing his business, and he's going to laugh at this episode. And so I hope you all enjoyed this episode. If you could, please, please, please leave us a rating and review on iTunes. We tremendously appreciate it. And if there's any way we can help, feel free to reach out to us on Instagram. I'm the Fi Guy, Ziana is Ziana McIntyre, and we'll see you all next week.
That's it for this episode of Investify. We hope that these nuggets of real estate wisdom lead to more savvy financial planning and a clearer path towards financial freedom. For more content like this, subscribe to the show at investify.com. Don't forget to leave a rating and share it with your friends. Together, we can transform more real estate newbies into successful and clever investors. Thank you so much for listening. See you on the next one.